Good morning, Lori.
Good morning. How are you?
All right on time, huh?
Might as well be.
Yeah, we're getting near the end of this course, huh? Not
Yeah,
too.
I can't believe it's gone by so fast.
Yeah. Are you glad you dropped 2:30 just for
Oh my
this?
God. Every day. Yes.
We have students who do both at the same time, and they do fine. And we have others who skip 110, and they do fine. But
Oh yeah, not me.
yeah, most of the people who skip to 2:30 end up dropping it immediately and
I
coming
believe it.
back here. All right, I guess we can get started. This chapter here, Lori, is a lot of repetitive things. They're going back into adjusting entries, and there's a couple of things that are in this textbook that the accounting instructors have decided we aren't even going to go over. Although it may be on your homework, and we'll adjust for that accordingly. So I'll show you what I mean here in a moment. Where is the PowerPoint? And now you see it, right?
Uh-huh.
All right. Get me set up here. Okay, adjusting for merchandising business. What we're going to talk about here, Lori, is a new adjusting entry under a perpetual system where you have been debiting merchandise inventory instead of purchases.
Mhm.
We were debiting purchases earlier in this course because we're on the periodic system and thus had to count the inventory at the end of the period. Here with the merchandising inventory, we're going to see a two-part adjusting journal entry. Prepare an adjustment for merchandise inventory using the perpetual inventory system. And they're just giving us a brief review here. Under the periodic method, we debited purchases and we credited accounts payable. And when we sold something, it was the basic accounts receivable, get cash, okay? Or revenues, cash or sales or revenue, that's fine. Worksheet for merchandising. Similar to the service worksheet, and we're going to use it for year-end adjustments. And it includes an adjustment to properly record the amount of merchandise inventory at year end. And I'm going to give you this expression. I asked some students if they've ever heard of this expression, and many don't. Out with the old and in with the new. You've heard that before, I'm sure, right? That's what we're doing here. Out with the old, in with the new. So let me demonstrate here. We have an adjustment for merchandise inventory, okay? Andy's Auto Parts had a beginning inventory of 25,000. And then at the end of the accounting period, a physical inventory of the merchandise shows that we had 27 at month end, okay?
Mhm.
Why is there more at the end than at the beginning? Well, obviously we purchased more than we sold, right?
Mhm.
Okay, that's not too tough so far. So we have 25,000 in the inventory balance since the beginning of the period, the beginning of the year, the beginning of the month or quarter, whatever we're measuring. Merchandise inventory account is not changed during the year because we are debiting purchases all the time. And it's only at the end of the month when we count it that we come up with the new inventory balance. So under the perpetual system, Lori and everybody, the balance in your merchandise, in your inventory account, in your merchandise inventory account is what you counted the month before, okay? So merchandise inventory, not changed. We count the inventory to get the new number. The cost of the merchandise sold is not recorded under the periodic system. And remember, we went into chapter 13 and we found out that under the perpetual system, the sales journal entry is the same. We debit accounts receivable and we credit sales. But under the perpetual system, we also debit cost of goods sold, and credit inventory. So that's why you don't have to worry about an adjusting entry under the perpetual method. Here we do. So after a year of purchasing and selling things, the merchandise balance is no longer accurate. No way it's going to be accurate. A two-step entry is needed to update the balance. 2 steps. Out with the old, in with the new. So what are we talking about? Step 1. The beginning inventory is removed by crediting the merchandise inventory account. In other words, we're closing it, just like we did closing entries. So we had a debit balance of 23,000. Step 1, credit it. Debit our old friend, the income summary account. Okay, so at that point, we have a 0 balance in the inventory. Now we're going to enter in with the new now. Now we're going to debit the inventory and credit the income summary. And that's pretty much the whole thing to grasp. And students have a little bit of a trouble with this. Some students ask, well, why don't we just adjust the difference of 4,000 there? And the reason you don't want to do that is you want to carry both the beginning and ending inventories over to your financial statements. The income summary is credited because this amount is also used in the calculation of cost of goods sold and net income. So when you get over to your last columns on the worksheet, the second to the last pair of columns, you're going to have the beginning inventory plus the purchases plus the freight minus the ending. Okay. Note that the debit and credit adjustments made to income summary are extended into the adjusted trial balance columns. You still need them at that point. This is done because the individual amounts are necessary for that calculation we just discussed. Beginning inventory plus purchases minus ending inventory. Okay. Let's take a look at what it looks like. Oh my goodness, there's more steps. What are they talking about here? Steps 3, 4, 5 in the adjustment process address issues related to customers returning inventory. This is the stuff I'm going to skip. Okay. And a couple of years ago, when we got this new textbook, all of us looked at this business of trying to estimate returns. And we decided that most companies don't do this, and we're not going to go through it. Okay. If I have to teach it, I have to learn it a little better myself. Okay. Adjustment for merchandise inventory. Same thing with the refunds. We are not going to worry about this. If you're interested, it basically means that companies must anticipate returns and refunds in advance. And we'll save that for accounting 230 when the time comes, okay? So they're introducing this new refunds payable account, which we're not going to worry about. Now, when you take the test, there should not be any problems on these items. And if there are, I will catch them immediately and add back the credit for it, okay?
Okay.
Adjustment for merchandise inventory. Estimated inventory to be returned, same thing. We're not going to worry about these estimated items, okay? Adjustment for merchandise, we're not going to worry. Adjustment for estimated returns. You know something, Laura, it'd be easier to just teach the darn stuff. It takes me longer to tell you why we're not going to do it than actually instructing you in it. But I can almost guarantee if you went into any business in America, 9 out of 10 times they're not doing that. That's just not a normal practice, I don't believe. Okay. You can read the numbers, Lori, on this page?
They're a little small.
All right, let me beef them up here. Oof, whoa.
Oh, that's good.
I didn't want to knock your socks off, but wow, that's
Nope,
big.
that's perfect.
Okay, so let's get the main thing we're worried about here is, like I said, where you see the estimated returns and the
Mhm.
refunds payable. We're not gonna worry about that, okay? Here is our unadjusted trial balance. Here is the pair of journal entries to adjust it. Out with the old, right?
Mhm.
Credit inventory for 23,000 and debit income summary. Out with the old. So at that point, the balance of the merchandise inventory is 0.
Mhm.
Now in with the new. We just counted the inventory. It's $27,000. We debit merchandise inventory and credit income summary.
Mhm.
Okay. And notice that they bring them both over to the schedule here, the adjusted trial balance. Okay. Because you're going to use them both when it comes time to do the income statement. The next two columns after the adjusted trial balance, Lori, you're going to see the beginning inventory of 23 and the ending of 27 on two separate lines. And everything else on here is pretty much the same, our sales and sales returns, purchases. So what do you think, Lori? Is this entry so complicated? We're not going to be able to master it in time for the test?
I think I think it'll be okay.
Yeah, we should be.
Should be.
But experience tells me, not in your case so much. Experience tells me we're gonna have a problem. I just started my new class in 110. There's a condensed class that just began, Lori.
Mhm.
They have to finish it in half a semester. I have 72 people.
Oh my gosh.
Jesus, 72. Anyway, Andy's Auto Parts. So let's take a look at our journal entries here. Journal entry 1. Out with the old. Journal entry 2. In with the new. These three guys I'm not worried about, okay?
Okay.
Now that we've put this all together, here is our income statement. Here is our beautiful income statement. All of this came from the adjusted trial balance being moved over to the appropriate balance sheet columns and income statement. Sales, less sales returns and allowances, net sales. I wish they had a separate line there for net sales, don't you think? I don't know why they don't show net sales.
Right.
But anyway, be that as it may, net sales are 135.2, and our famous schedule. Merchandise inventory plus purchases minus any purchase discounts to get net purchases
Mhm.
plus freight in, cost of goods purchased, goods available for sale, and we subtract the ending inventory, $27,000. Okay. And
Mhm.
that's pretty familiar. That's what we have done earlier, right? Quite a bit.
Right.
Continuing. Now here, look at this. Prepare an adjustment for unearned revenue. We know how to do this already. These are the gift cards. This is
Mhm.
you giving the lawyer, you getting a retainer if you're a lawyer. Cash received in advance before delivering a product or performing a service. You remember that?
Mhm.
You get the cash, you debit the cash, and you credit a liability account called unearned revenue. And then when you actually do something, you can reduce that liability called unearned revenue with the debit and credit an actual sales revenue account. Season tickets to my beloved sports world. You send money to the Dodgers today for this upcoming season. They got my check today for $12,000. They debit cash, credit unearned revenue. And when they start playing baseball, they will take 1/6 out of that liability and put it into ticket revenue. And here's the adjustment. Brown County Playhouse sells season tickets, $10 for each play, 5 plays per season. That's what $50 times 1,000. Okay. So here's what happened when they got the money. Debit cash, credit unearned revenue, unearned ticket revenue. They don't owe the public money. They owe theatrical performances. And here's the adjustment. Well, they did 3 shows. 3 shows times 1,000 tickets for each show. That's 3,000 tickets times 10, blah, blah. $30,000 worth of acting they've done. We reduce that unearned ticket revenue liability account with the debit, and we credit ticket revenue for $30,000. Any questions on that?
That's good.
Looks pretty familiar, right?
Mhm.
Entries for unearned revenue. Well, they're just repeating it here. We had a balance of 50,000 at the beginning, huh? Unearned revenue.
Mhm.
Now we've decided that we've acted $30,000 out of that. Now the balance is 20. I guess they have 20 more shows to do, and debit the revenue, unearned revenue, debit, or rather credit sales ticket revenue. Can you read all this easily enough, or you want me to bump it up? You're okay. They're just putting, in red, they're putting in supposedly new items that we really haven't seen. Merchandise inventory, okay? Out with the old, in with the new. Unearned subscriptions. I mean, we know that, unearned revenue. And we already know about sales returns and allowances and purchases. So there's really very little new so far in this chapter, huh? Prepare a worksheet. Have we done the long worksheet yet? I don't know. I think we've done it. Yeah, we've done it. Yeah. Prepare a worksheet for merchandising business. You got to get the trial balance. That's your first 2 columns. The adjustments, columns 5 and 6. So the trial balance after it's adjusted. Columns 7 and 8, you're going to go to the income statement, and columns 9 and 10 become your balance sheet. So let's see what they present us, huh? Well, here we go. They're giving us some entries, some of which, again, we're going to skip. Physical count shows that the merchandise inventory costing $45,600 is on hand at the end of the year. We're not going to worry about the returns. Supplies remaining on hand at the end of the year, 800. Unexpired insurance. Another way, that's a fancy way of saying prepaid insurance. Prepaid insurance, we have depreciation, and we're going to have to credit some wages payable. And they're talking about a magazine where subscribers pay in advance, huh? So we're going to do it as follows. Wow, look at that. I'll make it a little bigger, huh? That's big enough, huh? There we go. Again, just make sure we understand what we're doing here. Out with the old 52,000, and that goes into the account called income summary. Goes into the account called income summary, and then you debit the merchandise inventory. The supplies. Remember they told us the supplies were 800? Well, we had 6,000 to begin with. So we make the difference, take the difference, and that's the reduction of the asset and the resulting expense. This thing will let me fool around with this. Let me see if I can do something here. I don't know why it made it so. Oh, here we go. Now it's letting me fool around with it. Okay. So we did the merchandise inventory, prepaid insurance. Now it won't let me fool around with it. How come? Prepaid insurance. It was, I can't see this number here. Hold on. It was 2,800 and we used up 2,400 of it. So we're going to debit the appropriate expense.
Mhm.
Okay. So there's really nothing new here. Unearned revenues, they had 3,000. Now they've delivered that many magazines. This is all kind of, oh, now it's working for me, huh? I don't know. I must have hit the magic button. Okay. Is there anything on here that is at all unfamiliar to you at this point, Lori?
No, we've seen all of this. Yeah.
Yeah, I mean, it's a pretty basic review. Like I said, again, I go back to the merchandise inventory. That's all. You're running the difference through income summary, but you need to do it in two separate entries. Out with the old, in with the new. By the way, that out with the old, in with the new stuff, I had so much fun teasing my Asian students when I asked them if they knew that. None of them, the international students have trouble with these American expressions, and I ruthlessly teased them, Anyway, I shouldn't say that here. And here is our funny zoom. Zoom. Yeah, I'm afraid to touch this. Okay, there we go. Cash. You never adjust cash or receivables. Merchandise inventory, there it is. I was sick of me saying out with the old and with the new, and we end up with this new balance here.
Mhm.
What else did we adjust? Well, we adjusted these estimated returns. We don't care about that. And then we had some adjustments for more refunds. And we had adjustments for wages. We accrued some wages. We had, what was this one? Supplies, expense, insurance. So that's not so tough, right?
Mhm.
If you can get the first two columns done and the second two, you're just bringing them over to the adjusted trial balance. Okay. Now we have a nice adjusted trial balance. Here it is, these columns on the right, and they add up to 1,077,500. So we're good there. Okay. Let me get into step 3. Okay, let me go back. I'll tell you what I don't like. They didn't finish this up the way I would like to see. The adjusted trial balance. We had net income of 400,000, okay? And where did we get that? We got that from the sales of 473,000 plus and minus all of these other accounts. So that was our net income. When we go to the two columns that are the net income column, Lori, we are going to be out of balance by that amount, right? Because we're not bringing the balance sheet stuff over to the income statement. So by definition, if we had the two extra columns here that I'm annoyed they don't show, we would see that the credits exceeded the debits by 100,400.
Mhm.
So on the income statement column, to balance it, we would have debited it and credited the balance sheet and bring the debit over here. We're going to do in step 4, we're going to do the same thing for the balance sheet. We're going to be also off by 100,400 and bring that over.
Mhm.
If you like, I can give you a better presentation on that with a look at the full worksheet. Let me just move this down here. I'd like to make my own slides up someday. Journalizing. Oh God, more journal entries here. Now they're showing us the journal entries. The journal entries. So let's look at them. This is a good review for everybody. All of you out there in television land. Here we go. With the old credit the merchandise inventory. Now have a balance of 0. You put the inventory in. We're not worried about sales returns and allowances, estimated returns. We don't care about that. Supplies expense, credit prepaid supplies. Remember these, class? Debit insurance expense, credit prepaid insurance. Prepaid insurance is a deferred asset, and you're going to use it later. Depreciation expense, that's kind of the easy one. You debit depreciation expense and you credit accumulated depreciation, which is a contra asset account. And one trick question they like to put on the test is they'll say, we have the following entries. Goods costing $2,000 was sold, and we sold them for cash, and then we had a journal entry where the accumulated depreciation was such a number, and they'll want to know what the overall impact was on the assets. Accumulated depreciation reduces your assets. It reduces the assets. Your basic accrual for wages expense, that last week of the month that you worked, for which you will receive no remuneration for 2 more weeks, needs to be expensed in the month where you worked. Debit wage expense, credit wage payable. And here we have a magazine company, and people sent in $5,000 in cash, say, for future deliveries of magazines. Now you've delivered $2,000 worth of magazines, so you no longer owe this liability, and now you can claim the revenue for your income statement. Under the perpetual inventory system, the merchandise inventory, estimated returns, cost of goods sold, are continually updated throughout the year. And that's the whole point of the perpetual, that every time we record something that affects the inventory dollar amount and units will be immediately updated, and any related sales or purchases will be as well at the same time. So we purchase inventory, we sell it, and maybe customers return things and we return things to suppliers. So can you read this a little bigger?
No, I've got my book here too, so it's good.
Oh, very good, very good. The entries for the periodic versus perpetual, huh? So let's take a look at this now. We purchase merchandise on account. Under the periodic system, which is what we've taught for the first 12 chapters of this book, we were debiting purchases and crediting payables. Purchases is a cost account, an expense. At the end of the month, we have to adjust with a physical inventory. The entry to record a purchase is not to debit purchases, but to debit an asset account called inventory, merchandise inventory. Okay? So if we had $1,000 in inventory and we purchased 800 more, we have 1,800. Here, we would not know that until we counted the inventory. A sale on account. Under the periodic system, you record the sale the same way as you do in the perpetual, but look at the key difference. You also have to record the cost of goods sold. And the cost of goods sold is what we paid for this item that we just sold. So we sold a garment, say, for $400. That garment, we bought it for $300. And we put it into the inventory at $300. So now we sold it. So we no longer have the inventory. We reduced the inventory, and that gives you a related cost of $300. So you have a 4-line entry over there. Okay. Let's take a look at a return to a supplier. Under the periodic system, we debit payables and we credit purchase returns and allowances. You notice we don't have a purchase returns and allowance account under the perpetual system. We will debit accounts payable for $100 and we will credit merchandise inventory because every transaction that affects inventory is recorded immediately. Customer return things to us. Well, if you look at the two entries, they're the same as far as the return of the sales dollars, okay? Sales returns, customer returns merchandise we sold in the current period for a refund of $50. Well, we never debit sales. We know that for sure. We debit the contra sales account, sales returns and allowance, and we credit accounts receivable, or maybe we give them cash if they've already paid for it. The entry is exactly the same under the perpetual system, but once again, whenever you're recording sales or sales returns and allowances, there will probably be an impact to the inventory. In this case, we paid $40 for that item we sold for $50. So we got that $40 coming back into our inventory. We assuming it's still good, ready to sell, huh? Credit cost of goods sold. Any questions on that one, Lori?
No.
Yeah, the returns are a little trickier because you just like with a sale, you have to worry about the inventory cost of goods sold impact. And we're skipping the estimated returns. And then we have year-end adjustments, huh? These were normal everyday events. Now at year-end, month-end, really. Get rid of the old inventory, put in the new. Get rid of the old inventory, in with the new. And then we're not going to worry about these estimated or expected sales. And I think Cornelia will probably have a faculty meeting, which she normally does a few days before the new semester begins. And I'm going to ask about this estimated return stuff if we, decided to go through it. I know the other teachers, especially the ones that are active CPAs, they were saying they've never seen this stuff. So I don't know. Maybe that's New Jersey accounting. Sounds shady to me. Sounds shady. By the way, you've heard me joke around that New Jersey's the stupidest state in the union, right?
Yeah.
Because of the Jersey Shore. Did I tell you there's one other thing I totally forgot that makes New Jersey even stupider? New Jersey is now officially the only state in the union where you cannot pump your gas. You're not allowed to pump. You pull into a gas station in New Jersey. And I remember this when I was a kid, and when I was driving there too. In New Jersey, you cannot touch that gas pump. If you come out, some big Italian guy's going to come out yelling at you. What you do is you pull in and you're expected to remain seated in the car and you wait for the guy to come out or the woman to come out. You go, yeah, what do you need? You tell him $20 worth of regular, please. And then he pumps it for you, returns the pump, and then he collects his money and then off you go. And many people come to New Jersey not knowing you can't do that. And they get out of the car and they are just bellowed at. Get away from that pump. And just, if you're interested, Lori, it's a remnant of the old union days.
Oh, okay.
It's the one thing that whatever that union is said, look, Well, we'll let you lay off half of the drivers and half of the blenders or whatever, but darn it, we are still going to pump our gas under union rules. And Stephen Colbert,
Uh-huh.
he had on his old show, when he was on the Daily Show, he had the New Jersey Commissioner of Weights and Measures defend this. And the guy said, well, it's not that easy to pump your own gas. It's easy to start a fire. People don't know what to do in an emergency. They don't know the different types of gas. And Colbert said, well, the rest of the company does. Is that because New Jersey is stupid? Anyhow, I digress, class. Expected sales returns and allowances. We're not going to worry about expected. We only deal with when they happen, okay? We don't anticipate them yet. Here we go. Here's a new one, Lori. Shrinkage. Adjustment for inventory shrinkage. Did you know that the inventory can disappear sometimes and you don't know why?
Yep.
It can happen. It can happen. Something falls off the shelf. It's broken. Maybe you forget to record it, or somebody clipped something, stole something. Perpetual inventory does not eliminate the need for taking physical inventories. You may not have to take one every year, but you probably should. Just a recommendation. Perpetual records must be compared with the physical inventory to discover and correct any errors or losses of merchandise from theft, breakage, or spoilage.
Mhm.
And how do we do this? Well, it's done obviously by a very formal physical count of the goods. And at the end of and you enter all your counts into whatever system you're using, and you're going to see all the parts, part A, all the way down to triple Z, say. And part A, you're going to see balance per the perpetual, 10, balance per the count, 9. And you adjust accordingly. Now, during the year, the book doesn't talk about this, but during the year, what a lot of companies did, and I always did, we took what were called cycle counts, where we would count maybe 3 or 4 items a day. And in any population, including inventories, Laura, you ever hear of what they call a Pareto analysis?
Mm-mm.
Pareto analysis. What it means is any type of population, 20% of the units in a population will equal 80% of the total value of the whole.
Mm.
So the idea is you divide your inventory into what we used to call A, B, and C items. C items were the real cheap things. B were the less expensive, were a little more expensive. And then the A items were the ones that had a healthy cost to them. So every day we would count maybe 3 A items, 1 B and 1 C, and then compare them each day to the perpetual. And as long as we kept tying out, we were okay. We don't wait till the end of the year and take a physical inventory to find out you're all screwed up. That's all I'm saying. So any difference between what the perpetual says the balance is and what the reality is, they call it shrinkage. And the differences found between the perpetual and the amount in the inventory must be corrected with an adjusting journal entry. And I guess we're going to credit inventory, huh? So here we go. A physical count came to $3,710 worth of merchandise, but the inventory count had a balance of $3,840. So obviously we're going to adjust our general ledger to what the physical count is. You credit merchandise inventory and you debit an account called inventory short and over. You notice it says short and over? Why do you think it has over there too?
Well, in case the reverse is true and you're
Exactly right. Yeah. You can go out. What if, you can go out there and you say, well, the perpetual says we have 50 of these and now we count them. Hey, we got 55. Isn't that great? Then you would debit the merchandise inventory and credit that account. Absolutely right.
Okay.
And one thing that used to drive me crazy. And this is back in the old days. You'd get all this done in like pencil, on a big long spreadsheet, and you'd start looking at the differences, and you'd see minus 700, and then you'd see 2 lines down plus 700. And you'd often see the same number on each side of the adjustment. What that indicated was they confused two part numbers.
Mm.
And, even though you figured that out, it was still a pain in the neck.
Mhm.
Okay. Inventory shrinkage. And that's pretty much this whole chapter here.
Okay.
So not too much in here. And
No.
then in chapter 15, they kind of tie it all together in terms of the merchandise inventory. And what's today? Today's the 15th. So the next chapter is on the 22nd. And then we've got about 4 weeks,
Mm-hmm.
to go over the remaining 2 chapters, which deal with payroll. Hopefully that'll be a bit interesting for us.
Yeah.
And then we float into the world of the final exam.
Excellent.
So what do you think, Laurie? Any questions on this chapter here?
No, this one I hadn't even looked at chapter 14 yet, but it's actually pretty straightforward. Like you said, a lot of review. So
Yeah,
good.
no, absolutely it is. Have you signed up for 230 yet?
Not yet.
Okay, all right. Well, maybe see you in that next semester.
You just might.
And I have to ask you, have you done any significant baking in the last day or so?
No, I gotta tighten the reins on that.
How so? Making too much good stuff?
Uh-huh. Everything in moderation.
Yeah, that's how it used to be for me until the pandemic. Now I put on a ton of weight again. I got to get it off. But yeah, I better stop obsessing about baked goods.
It's hard. They're good.
All right, Lori. Well,
Okay.
we'll see you later, I guess, huh?
Okay. See you next week.
Hey, bye-bye.
Bye.